Hi everyone, JJ here. Welcome. Well, today I'm going to look at Spotify earnings. It's this morning. Good morning. If you're in the US, it's pretty early morning and they do report early and the earnings are already out and the stock has jumped. I think it has. Let's have a look. Let's see what the stock is doing right now. It's 5.2% up, and we have the earnings out, and the earnings call is coming up. So hopefully you'll join me on that. I'm going to look at it. I decided to share with you. This is just what I'd be doing anyway. Probably wouldn't be doing it live like this. I'd be doing it a bit later because where I am in the world, it's very late. It's after 1 a.m. But I'm going to listen to the earnings call live and see the updates of what's going on with this. We can see this article that's already come out, and it is this: Spotify jumps on improved margins and strong guidance amid price hikes. Podcast pivot. So let's see what they're going to say. I'm going to go through the investor deck, which is the main thing, and then earnings are at 8 a.m. Eastern time, so that's less than an hour, about 50 minutes away. So we'll do that. Hopefully some people will join me for that. Excuse me, they've got to take a drink. It's been a long day. But I'm plowing on. So this is what it says. Spotify reported fiscal fourth quarter earnings on Tuesday that missed expectations, but strong guidance helped boost shares in early trading as the music streaming platform continues to focus on profitability amid recent price hikes and changes to its podcasting strategy. Yes. I'm just going to check to see we're working here, by the way, because I just don't want to be talking to nobody. I apologize for the quality. I'm just testing this software, by the way, so it'll get better. This is a different format than usual live. Don't usually do live, but I thought I'd just try it out. So, it's just the basic here, but we'll see how we go. Let me see if I can get this working. See, it's working. I can hear myself on there, so we'll go on. So they say the company reported an operating loss of 75 million euros. I think it was not a loss last time, so the market might be disappointed by that. But not too disappointed given that the stock price is still 5.76% up pre-market. So it'll be interesting to see what happens on the earnings call, if it actually goes up or goes down, or what they say. I think, well, let's see what's going on here. Let's see what they say. The company reported an operating loss of 75 million euros in the quarter amid severance and real estate related charges, but guided to strong Q1 operating income of 180 million euros. So that's probably the reason for the pre-market enthusiasm, which sent shares higher, they say. This is Yahoo. The streaming service reported a net loss of 70 million euros, $75.2 million, or a loss of 0.36 euros per share. That missed analysts' expectations of a loss of 0.31 euros per share. I mean, this is just analysts' expectations, don't really take into account, really. You got to do your own work on these things. This is what this is about. We're going to look at the information in depth, in detail, which I don't usually do on a 10-minute video. This is probably going to be more of an epic video here, probably closer to 2 hours once the earnings call is finished, if I can manage to stay awake, but I'm feeling okay. It also compares with the year earlier period loss of 430 million euros, a loss of 2.23 euros a share. The loss comes after the company turned a profit in Q3. It did for the first time. So it's interesting that the stock is up, even though they didn't turn a profit this time. It's interesting. I like to compare it to Amazon. People were disappointed by Amazon's continued losses throughout the years, and really they could have shown a profit if they wanted to, but they prioritized growth and investing in themselves. And I know that Daniel Ek, he does look to Jeff Bezos's, approach that he's had over the years. So it wouldn't surprise me if Spotify is kind of doing the same thing. They're just concentrating on growth. Daniel Ek in the past has talked about getting to 1 billion users, and I think they're kind of well on their way there. Monthly active users, we'll have a look at that. We'll just read through this a little bit. Gross margins, however, came in stronger than expected at 26.7%, slightly beating company guidance of 26.6%. By 0.1%. The streamer said it expects margins to tick down slightly to 26.4 in the first quarter, primarily driven by year-over-year improvements in music and podcasting. All right. Expects to margins to tick down in the first quarter, driven by, okay, all right. The company has previously said it expects the metric to come in between 30 and 35% over the long term amid plans to further scale its podcasting and ads business. With the exception of Q3, margins have been stuck between 21 and 25% in recent quarters. So a little bit better. I noticed there was news just in the recent days about Joe Rogan, redoing his contract, and it's quite different. It's not going to be exclusive to Spotify. If we have time, we'll look at that. They might talk about that on the call, but it's a lot of money that they're paying him, but it's going to be on different platforms as well. Revenue, meanwhile, totaled 3.67 billion euros, 16% higher compared to Q4 2022. So 16% higher revenue, but slightly below Wall Street expectations of 3.72. All right, Wall Street expectations. Spotify guided to Q1 revenue of 3.6 billion euros. Spotify's stock jumped in pre-market immediately following the results, up nearly 10%. I did see that, but it's sort of fallen back. It'll be interesting to see if it, continues up. I'll keep track of what the stock price is doing before the earnings call, which is in about 40 minutes. It's 5.49% up as I'm speaking. So it's interesting that it's gone up. It's positive. Total monthly active users beat company estimates of 601 million. 601 million monthly active users is pretty incredible, don't you think? I mean, are there other platforms with that many who aren't kind of, what are other companies with that many users? What is that worth? And to hit 602 million in the quarter, a 23% improvement compared to a year ago. The company anticipates Q1 MAUs, monthly active users, to come in at 618 million. So as I said, Daniel Ek's trying to get to that billion. I think he's got his sights set on 1 billion monthly active users, and they're really getting there. It seems like they could get there relatively quickly. Premium subscribers also surpassed Wall Street expectations of 224 million. So 618 million active users, but 224 million premium subscribers, jumping another 16% year over year to hit 236 million. A 15% year on year jump. Spotify expects premium subscribers to increase to 239 million in the first quarter. Okay. So things are looking pretty good. Just check that we're looking good at the moment still. I'm just gonna, because last time I did a live stream, it's okay. Last time I did a live stream, the picture froze and it was terrible, and I was talking to nobody. So let me know if that actually happens here. This will be recorded, for people to watch later. But I can see your comments if you want to leave a comment of people joining the stream. Let's see. So what we are going to do now is look at the investor deck. And just looking at YouTube, sorry. All right, so I think we've seen enough of that. Let's go to the investor deck because that's what we're here for, and I don't want to run out of time before we've had a chance to look at that. Here we go. So this Q4 2023 update is the stuff. So we've got the executive summary, the key highlights, financial summary, MAUs and subscribers, product and platform outlook, and financial statements. Let's see what they have to say for themselves in the executive summary. See if I can make that a little bit bigger no, can't do that. Okay. We ended 2023 with strong Q4 performance. And you can see the numbers on the left here before I get into that. You can see, okay, users, monthly active users at 602. So that was a 23% year-on-year growth and quarter-on-quarter 5%. So 23% year-on-year of monthly active users. That's pretty impressive for a platform this big that's still growing its users that much. Premium subscribers up 15% to 236. So it was 226 last year. And ad supported. So that's kind of, ad supported. Where I am, I'm a premium subscriber, of course, but when they did have ads, they didn't have many. So, they'd be ramping up their ads over time in different parts of the world. Well, they're all over the world, a truly global company for sure. So 28% year-on-year growth and 5%. So it's pretty strong, decent growth there. So in their financials here, we've got premium with 17% year-on-year and ad-supported 12%. So that's lower, 12%. Ad-supported year-on-year. So total revenue was 16% year-on-year and 9% from the quarter-on-quarter. Gross profit 26.7%. That's what they're talking about in that article. So it's going up. Look at this. So Q4 2022 was 25.3% gross margin, and in 2023, 26. So it's edging up. That's definitely a positive that the market would like to see. It's going to be interesting, this earnings call. Stick around for that. If you're watching this later, do stick around for that, because that's the good stuff of what they actually say, and the price could move. So, but gross margin's going up there, really interesting, edging up there from 2022 to 2020, end of 2023. 26.7 from 25.3. So it's going up. That's positive. That's definitely a positive. Operating loss income. So yeah, there's that loss of 75 million euro, not dollars, and 32 last time. So that was a positive. The market really liked that last time, and the stock has had a good run. Let's just pause and see that stock. I'll share that with you. So we can see that year to date, it's up 18.25%. But over the past year, I don't know, not many people have been talking about this, but Spotify's been doing pretty well. The stock has been doing pretty well. 81.62. You wonder if it has something to do with AI as well, because they have got an AI DJ, which I've been using, and it's good. It's pretty good. Could be better. But as a start, it's pretty good. So the 5 year, it's up 65.73 over 5 years. So it's not great performance, and it went through this as many emerging tech stocks did. We went through that huge upswing of nearly 200%, and then way down to Funky Town to minus 80% down, like many emerging tech stocks did. I mean, say emerging tech, but this is not a small company. Market cap there, 43 billion at this point. That's not a small company. So, but then launching off this low here, it's up 214%. So if you're one of the lucky people, or luck, because it's hard to time the bottom, you can't time the bottom to capture that, then you'd be pretty happy. But even so, over the year, year to date, still pretty good. It's going to be interesting to see what happens this year in the market. If you look at stocks like Nvidia, it's just had a huge run. But let's go back to the investor deck now and carry on with what they say, the executive summary. So their comments. I always like to hear what Daniel Ek's got to say. He's really he's really the leader of this. It's good to have sort of founder-led companies. I like that. It's a good sign. And, if you think of Meta, it's had a meteoric run lately after a big dive as well. But, Zuck has turned out to be a pretty good leader, good CEO after getting lots of criticism. And he's really driving. Could Spotify be a Meta of the future? Sort of under the radar at the moment. So I'm going to move on with this. It's about half an hour away nearly from the earnings call. Looking forward to that. So the executive summary is we ended 2023 with strong Q4 performance as all of our KPIs met or exceeded guidance. Monthly active users net additions of 28 million surpassed guidance by 1 million. So good performance there. Subscriber net additions of 10 million were also ahead by 1 million. Additions of 10, so that was pretty big bit of beat there on their subscriber additions, and revenue grew by 20% year on year on a constant currency basis, reflecting another 300 basis points of sequential acceleration versus Q3 2023. Gross margin of 26.7% was also ahead and up 140 basis points. I don't like how they say basis points year on year. While operating loss of 75 million was better due to lower marketing and personnel and related costs, excluding 145 million euro in charges associated with efficiency actions taken late in the quarter, which were incorporated into guidance. Okay. We generated 68 million euro in adjusted operating income. Adjusted, you know what Charlie Munger used to say about adjusted income? It's BS income. More than double the operating income was achieved in Q3 23. Free cash flow was 396 million in the quarter. So free cash flow there, 396. Last year was 216, and then negative 73. See, the market would like that too. The free cash flow. Why is there an asterisk there? Let's see. Constant currency adjusted operating income and free cash flow are non-IFRS measures. Okay. IFRS is the international measure. Right. Okay, that's nothing big there. Let's just check. I'm going to check the price again, see if it's moved at all. There's no reason it would. So it's settled at 5.62% up after market. That's $235. So $235 to nearly $236. So it'll be really interesting if it keeps that up. So key highlights, here we are. Let's have a check of this. Key highlights says monthly active users and subscriber outperformance drives record full year results. MAUs grew 23% year on year. Okay, that's a good number. It's impressive. 23% at the size they are, about of 600 million. You know, they've still growing 23%. And that's worth thinking about. It's an impressive number. You know, whatever the financials are doing, you know, as I said, Daniel Ek's saying we want to grow, just like Amazon did when people criticized that they weren't making a profit. You know, could they ever make a profit? And look at Amazon now, because they just want to dominate the space, and they've got competition. I saw somebody today talking about, when I was preparing for this, just, you know, looking at different YouTube videos, people were talking about how, it might have been Joseph Carlson actually, talking about how that they are not profitable, not showing a profit, struggle to show a profit because of their music licensing, but they do have a lot of irons in the fire. They're reinvesting for growth a lot, and the growth is pretty phenomenal. It's 602 million. So that was 1 million above guidance, grew 23%. Net additions of 28 million represented the second largest Q4 net addition performance in our history. Wow. Okay. Well, is that on percentage wise? I guess so. Contributing to record full year net additions of 113 million. Premium subscribers grew 15% year on year to 236 million. 1 million above guidance. Q4 net additions of 10 million contributed to record full year net additions of 31 million. Okay, so premium subscribers grew 15%. So monthly active users grew 23% and premium 15%. I mean, I don't mind, but either. I mean, they've got this. If you think about Netflix, people often compare, Spotify to Netflix. And Netflix has just started this ad tier, instead of subscriber base. And Spotify's had these all along, both of these things. So it's that they've grown it right from scratch. It's a bit of a shock to people, although in Netflix to have ads, but people according to their last earnings, it was fairly popular. So, but Spotify's had that all along, and so the potential to grow ad revenue is big, I think, in the future. Definitely. All right, let's see. I see a couple of viewers there. Thank you for joining, and stick with me for the earnings call. I'll come back. I'll be here for a while. As I said, this is just a new format, just trying it out. So bear with me. It's a lot more casual and obviously a lot longer than my 10 to 15 minute videos. Accelerating constant currency revenue growth and gross margin expansion. Okay, yeah, gross margin expansion that's the thing that the market likes, I think, and I like that. I mean, continual gross margin expansion is good to see, even though it's just small. But compared to Tesla, where margins are going down, Spotify slowly going up. Total revenue grew 16% year on year on a constant currency basis. Total revenue grew 20% year on year versus 17% in the year before. Gross margin, versus 17% in Q3 2023. Gross margin finished at 26.7, up 140 basis points. 1.4%, that is. All right. So, 9th annual Spotify Wrapped campaign draws more than 250 million monthly active users. Well, it's so popular. I see it all over, being shared all over the place. It's a good thing. I've seen other services trying it too, trying a similar thing, not just music, but with all kinds of things, just as a history of showing people what they've done throughout the year. I'm sure you've noticed that too. So it's been really successful for them. So they say users engaging with the 9th annual year-end Spotify Wrapped campaign grew more than 40% year on year across 170 markets. 40%. That's pretty impressive. I noticed they left it up for a long time too, and really made an effort to get people to look at it. Expanded the Spotify audience network into 5 new markets. They really are a global company, like Netflix. I mean, it is sort of comparable to Netflix, really, but they're not producing as much of their own content like Netflix does. Although podcasts, I mean, they're paying Joe Rogan a lot. You could say that's producing their own content. It'd be interesting to hear more about that. If they say in the earnings call they do pay him a lot, but he has a massive audience. In November, incorporated over 200,000 audiobook titles. Audiobooks is their next vertical. So they've got podcasting, audiobooks, titles. It's not here where I am in the country I am in New Zealand yet. Looking forward to it. I still use Audible. I'm still using Audible, so it'll be interesting to see if they can get people across some audio. Audible that's owned by Amazon, of course. So that's really the big competitor there. In November, incorporated over 200,000 audio titles into our premium offering in the United States. So let me know if you've been listening to audiobooks through Spotify in the US. Let me know what it's like. Are you enjoying the experience? Is it good? I think they said 15 hours, which is really one book, maybe less sometimes. 15 hours a month, so it's basically one book a month. After having Audible for a long time, I've like 200 or more books on Audible over the years, so I'm really interested to check out the Spotify one. I hope it starts here really soon. They buy it. I noticed that the price that you buy it's more expensive than Audible, but I'll switch over. I switched podcasts to Spotify. I listened to a podcast on Spotify. I did that. So in November, incorporated over 200,000 audiobooks. I've read that. Unveiled our first ever personalized in-app merch hub. I noticed that in mine. So I wonder how that's going. You see that in time. So key highlights, actuals versus guidance. Okay, so I'll just check the share price. Speaking of guidance and what people are thinking about it. So it's 6.38%. It's going up again as we get towards the earnings call, which is not far away now. Don't want to miss that. I am really interested to see what they're going to say here. Okay. Right, so monthly active users. So above the actuals versus guidance. So guidance was for 601, active users 602, and for premium subscribers it was 235 and they were 236. So they beat on guidance. I mean, you wonder about guidance here, whether they underestimate here, they're conservative, which is probably true because the market likes it. Financials guidance was for 3.7 total revenues, and it came in at 3.7, in line, above. Gross margin was above. The market loves that. Slightly above. If they can keep the gross margin going up and the operating income loss, I mean, the market does not like to see a loss, but as I said, Amazon for years and years was that, and then it's interesting, isn't it, that last quarter they showed a profit and now they're not. And Amazon was like that too. They just didn't, and then they kind of give a sneak peek and almost like say, okay, we'll show a bit of profit. We'll just show them what we can do, and they just, pulled some levers and showed a profit, and then back, and then the next time not. So saying we can do it if we want to. We're just in growth mode. We're reinvesting. We don't really care about it. It's for later on. I do think that Spotify could be like that. I really do, considering that Daniel Ek has talked about Jeff Bezos' strategy like that in interviews. I've heard long interviews where he talked about how much respect he has for Bezos. All right, so we've got 20 minutes to go. So the financial summary, we've been through this. I'm just going to flick through this. This is only page 7, so we've kind of been through this, but so financial summary, this is good because it shows more years. So total month of active users here. So we're up to 602. That's 602 million. It's incredible. It's incredible. So 23%. But if you look back to 2022, it was nearly 500. So they've increased. Well, 2023, Q1 2023, it was just over 500 million, and now it's 600. It's compounding growth. Exponential. Premium subscribers, 233. Back in 2022, it was only 200. Well, it's not a huge jump, is it? So Q4 2022 to now it's 36 million difference. Ad supported's gone up. So financials, premium, that's the premium is 17% year on year. Ad supported 12%. Total revenue 16% year on year. It's all right. It's double digits, isn't it? It's not 30%, it's not 50%, but it's going well. gross margin, yeah, and gross margin's creeping up. If you look, if we go back to 2022, Q4 2022, it was 25, low 25s, and now it's high 26s. So, they are coming up with the goods there. It has to be said, and that's why the market is, I think, digesting this information just as I am. And now it's 7%. Look at this. We're up to 7%. 7% up. Is it the same there? I don't. Hold on a minute. 6.7. It says on Yahoo. I don't know. This is probably delayed somewhat. It's nearly 7% up. It's looking good, and 238 if it opens like this and keeps going. Okay, so we're back to the summary. Let's have a look. What else we got to glean from this? Operating loss. Operating margin. Okay, yeah, that's low. It's 2%, minus 2%. It was 1% last time, so really just marginally. Operating margin just 1% last time, and now it's slipped back. But it was 7.8, 5 minus 7.8, minus 5.1, and minus 7.3. So it's not slipped back. It hasn't slipped back a lot, but it slipped back. Net cash flow and liquidity. Free cash flow 396. It was 216 in Q3 2023. I think we've this financial summary. I think we've kind of covered all that. I don't want to go over it too much. Revenue grew 16%, 20% on current constant currency. Premium revenue growth 17%. Profitability. Here we go. What have they got to say? Gross margin was 26.7 in Q4. Up 1.4 basis points, reflecting improved podcast and music profitability. Improved podcast and music profitability. Look, they've invested so much in podcasting, and people were very skeptical, but I think it's paying off, and potentially that's where better margins are than their music that they're licensing. Other costs of revenue favorability partially offset by audiobooks startup costs of 4 million. Well, that's not much. Said it. Audiobook startup costs of 4 million euro in net severance related charges. What does that mean, really? Need to see more detail on that. Operating loss was 75 million in Q4 and reflected 144 million in net severance related and real estate optimization charges. I think they've been scaling down their real estate. I think I read something that they were reassessing the real estate that they have, or the offices and so forth. 139 million of which we are included in operating expenses, including these charges: adjusted operating income. Adjusted, Charlie Munger would not like that. Adjusted income, operating income. Higher social charges, which were more than offset by lower marketing spend and personal and related costs. Okay. Free cash flow. Restricted cash. Okay. Revenue. Okay, there's the graph of revenue. There's the graph of revenue. Premium growth led by subscribers and pricing. Premium growth led by okay. They have put their prices up, so it's interesting to see that that's be a reason that the margins are tipping up, because they did increase their prices. So many businesses have been increasing prices based on inflation, right, over the last year or more, and they've increased prices. They did in our market. I think it's a sticky service. I don't think people who have premium would ditch it if they've, it's one of those services I wouldn't ditch. That's why I'm interested in the company. Like, it's super sticky, and you get more. There's more and more value when they started adding the DJ. I don't know if you've used the AI DJ, but they've added value all the way along, and now it's audiobooks. So I think if I had that, I'd be definitely, well, we've got a family plan, so it's pretty good value for four of us. We all use it a lot. We all use the family plan a lot, for it's pretty good value. So I could see them they wanting to, in terms of pricing power, they could increase their prices. That's how they could show profit if they really wanted to, just like Amazon. I mean, Amazon wants to lower their prices, so it's different over time, make things cheaper but for the customer, and that's what I think Daniel Ek does. He wants to give as much value. He says this all the time. I want to keep giving me people more and more value, more and more services, more value for the same cost, or even just a slightly more. So they haven't really increased their prices very much at all, and I don't think many people, if any, would. Well, I mean, there is always people who cancel, but I don't think it's a pretty sticky product. I've tried Apple Music. I mean, it's not just music, that's the thing. But I've tried Apple Music, and it's just not as good. I just couldn't say that. I just was not that impressed with it. Although they've got some things. I was listening to Neil Young, which Spotify doesn't have, because some artists do have a problem with Spotify not paying them very well, and Spotify has itself a problem with Apple being a monopoly and taking a lot of their app store revenue or commission. So it'd be good if that changed. 10 minutes to go to the earnings call. Let's get on with this. Premium revenue grew. So premium growth led by subscribers and pricing. Reflecting subscriber growth of 15% year on year and premium ARPU increase of 1%. Okay. To €4.60, up 5% year on year. Okay. Including the impact of FX. ARPU performance was driven by price increased benefits, partially offset by product and market mix. Ad-supported revenue hits an all-time high. See, this is interesting. Their ad inventory used to be terrible when I wasn't a premium subscriber. I don't know about where you are. Let me know if you've had any different experience. But it was pretty. The ads were just. I mean, they were purposefully annoying. They're mostly ads for the service itself to go premium, but there was the odd local ad, but they could do more of that. Just like if you think of how many ads radio has, they could ramp up revenue a lot. Ad supported revenue grew 12% year on year, or 17% constant currency, reflecting year on year growth across all regions. Music advertising revenue grew double digits, driven by growth in impressions sold and stable pricing. Podcast advertising grew. Okay, this is interesting. Podcast advertising revenue grew in the healthy double-digit range, driven by significant growth in sold impressions across original and licensed podcasts and the Spotify audience network, partially offset by softer pricing. So if there's a recession, that's advertising gets hit, but hasn't hurt Amazon. The Amazon earnings, their advertising is doing very well, and Spotify will be looking at them, saying that because the advertising is definitely part of their future. That subscriber growth is just one part of it. Advertising is a big part of the future, and in podcasting with higher margins, hopefully. Well, I would say. The Spotify Audience Network saw a double-digit quarter-on-quarter growth in participating publishers, shows, and advertisers. So what's this? Supporting revenue. Okay, gross margin screen. Okay, we've got 10 minutes to go before the earnings call. Excitement. What are they going to say? It's always good to hear Daniel Ek talk, I think. What are we on now? Let's have a look. Let's have a look at the share price. 8%. Share that screen. Here we go. Look, 8%, nearly 8%, 7.95% as I speak. It's really getting up. It leapt up earlier on, and it's gone back up. It went down, and now it's gone back up. So if it opens, it's going to be interesting to see what we'll check during the earnings call, because it does fluctuate during the earnings call. Whew. I'm not used to talking for this long. All right, especially it's 1:50 in the morning here, by the way. All right. Gross margin, podcasting and music gains and other cost of revenue favorably aid expansion. Total gross margin is 76.7. Premium gross margin 29.1. Wow, premium gross margin, so that's higher. Premium gross margin was 29.1 in Q4 up. It's good that they broke that out. 45 basis points year on year. The year on year trend reflects improvement in music profitability aided by marketplace growth and other cost of revenue favorability, partially offset by audiobooks startup costs. Startup costs don't, considering how much they invested into podcasting, audiobooks seems to be not as much. Ad-supported gross margin is only 11.6. Ad-supported gross margin 11.6 in Q4, up 645 basis points year on year. The year on year trend reflects improvement in podcast trends and music profitability, as well as the other cost of revenue. Cost of revenue favorability, partially offset by severance and related charges. Okay, operating expenses down, but just if you look at that graph, total operating expenses year on year and total operating expenses, the green is total operating expenses and the blue line is total operating expenses year on year. So leveling off, they've been doing a decent job of curtailing their operating expenses. This curve up here was when they were investing heavily in podcasting for sure. And items affecting operating expenses. As a reminder, social charges and payroll taxes associated with employee salaries and benefits in select countries where we operate. Blah, 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 blah. We've seen that. But operating expenses going generally sort of leveling off there and going down a little bit up. But still doing a decent job of leveling it off. Free cash flow, building a sustaining and strong balance sheet. Okay, we're getting close to the earnings call, so I'll just go through this a bit more quickly. Building and sustaining a strong balance sheet. Free cash flow. Free cash flow was, as a result, it's 396 million. Net income adjusted for non-cash items. Additionally, capital expenditure declined 4 million. Okay, then we go to MAUs, monthly active users and subscribers. This is an interesting graph, isn't it? So look, over the years, since Q19, it's been pretty good in all areas. So Europe, North America, Latin America, and rest of world. That's me, rest of world, but 32%, 22%. So growth across the world there. Sustained double-digit year-on-year growth in all regions, outperformance in Latin America and rest of world. Yeah, it's a global business, isn't it? It's a truly global business. I am just going to go in the background here and see if I can see what's happening on the earnings call. Prepare for this. Okay, we're on mute there. It's not working. Spotify. Let's see. Welcome. Just bear with me here while I set up this earnings call so we can hear it. Just put in this. Join event. I can hear it, so I'll swap over when we get to it. So I'm gonna swap over to it now, so you can see it and make sure that we can hear it.
Producida por Emisor Podcast.
I've been in live situations where it wasn't the sound wasn't working, and that was embarrassing.
Bienvenida entonces a E55.
¿E55?
Lo llamamos simplemente el Enigma 55.
Okay, seems to be working. It's good. Let me know if it's not. Let me know in the comments if it's not, because that's just, it'll be embarrassing and I don't want that. But it looks like we're set to go, so that'll be good. What am I actually showing you? This is the earnings call. So it's at 8 o'clock. We've got 3 minutes to go. So it's going to work. What's this here? Spotify earnings. So there's questions from the audience. Here, let's just flip over that. Okay, I'm just going to switch back to this and just flip through there. Product and platform annual wrap campaign. It goes through that. Building, you can have a look at this in your own time. The earnings deck, I thoroughly recommend having a look at this in yourself. Building the world's, I mean, if people who look at this stuff, a lot of investors don't look at this stuff. They're just picking stocks and not even looking at any of the fundamentals or anything, which is this. This puts you one step ahead of most, like probably 90% of investors. Building the world's #1 audio network. Yes, music. Outlook. Here we are. The guidance. We better look at the guidance. So, the following forward-looking statements, blah, blah, we know, implies the addition of approximately 16 million MAUs in the quarter. Outlook for Q1 2024. Premium subscribers 239, approximately 3 million net new users. Total revenue 3.6, approximately 250 basis points. Gross margin 26.4, primarily driven by year-on-year improvement. So that's actually lower, but are they underselling it there because they want to beat on the margin? Operating income 180 million. Social charges are based on Q4. Okay, so just checking the earnings call there. So that's it. We've been through, and then there's the financial statements, trending charts. It's all going up and to the right. Kind of good. It's leveling off a little bit, but it's going good. Trending charts. Look, the trend is going in the right direction, which has probably got a lot to do with how the share price is doing after the stock price is doing at the moment. So that's all we have. Let's swap over. It should be starting now.
Podcast platform. That is a lot of P's. The Louis Theroux podcast
Now
is a Spotify podcast. Now
We've got questions here. You can type questions here, but there are quite a lot of questions. It'd be interesting. Have podcasts flipped into positive? These are interesting questions. I hope they answer some of them. Have podcasts flipped into positive gross profit yet? And how do you think about inflection here through 2024 as you're rationalizing content spending?
Other people able to listen in.
With advertising revenues still under 14%. We can vote on them, okay. Yep, I'll vote on that. And with advertising revenues still under 14% of your revenues, yes, we noticed that. Surprised is not growing faster than subscription revenue. How do you accelerate advertising growth to reach your goals of it becoming 20%? I'd like that, yes. Because that's potential. Advertising has got a real potential. If you look at Amazon, it's becoming a behemoth within Amazon. Sort of under the radar, but definitely could be impressive for by Spotify as well.
Contador, cállate a la verga.
They're not on yet. Right, so it's going to start soon. We're after 8 o'clock. So, so can you provide an update on Marketplace and how that performed in FY 2023? How should we think about continued momentum? Okay, yep. I'll add to that. There was the first. What are the most impactful steps that will help you progress toward your long-term music gross margin goal of 30 to 35%? I wonder if that's ever going to happen. Can you share more detail on the gross margin levers in 2024? Okay, I do want them to answer that. Have podcasts flipped into positive territory?
23 earnings conference call. Joining us today will be Daniel Ek, our CEO, Paul Vogel, our CFO, and Ben Kung, our VP of Financial Planning and Analysis, who's been assisting with the transition while we search for our new CFO. We'll start with opening comments from Daniel and Paul, and afterwards we'll be happy to answer your questions. Questions can be submitted by going to slido.com, slido.com, and using the code #SpotifyEarningsQ423. Analysts can ask questions directly into Slido, and all participants can then vote on the questions they find the most relevant. If for some reason you don't have access to Slido, you can email investor relations at ir@spotify.com, and we'll add in your question. Before we begin, let me quickly cover the safe harbor. During this call, we make certain forward-looking statements, including projections or estimates about the future performance of the company.
It's important to listen to earnings calls.
Current expectations and assumptions.
It's important to listen to earnings calls because this is where, especially the Q&A session, they'll go through some of the things in this deck that we've already seen, but it's interesting for these quick Q&As.
Non-IFRS financial measures.
If the analysts actually ask good questions, sometimes don't even ask hard questions at all. It's sort of too easy.
And also furnished today on Form 6K. And with that, I'll turn it over to Daniel.
All right. Thanks, Brian. And hey, everyone. And thanks for joining us.
It says it's working. Thanks, Pat.
I hope you've had the opportunity to review our shareholder deck to get a sense of what an incredible year 2023 was for Spotify. Throughout the year, we notched some really significant milestones and set numerous records. This included 113 million net adds on the MAU side and premium net adds of 31 million, both the biggest full-year additions in our history. And our annual Wrapped experience also toppled previous levels of engagement, surpassing 2022 numbers in just the first 31 hours of the campaign. We accomplished all of this by significantly exceeding our own expectations when we entered the year and against the backdrop of global turmoil and uncertainty, and Q4 was a continuation of this story. And while I'm pleased with the level of growth we saw in 2023, perhaps what is even more gratifying is that it also marked a very different year for Spotify, a true evolution in how we operate our company. A year where we started to prove that we're not just a company that has an amazing product, but one that also is building a great business. And there's no question that we had to make some difficult decisions to put us on track to achieve our goal of being a consistently profitable company, but by taking these steps, I'm super confident in where we're heading. So looking to 2024, you should expect a continuation of what you saw in 2023. Strong product development, which leads to strong growth, but with an increased focus on monetization and efficiency, which in turn drives profitability.
Yes.
And
Good.
I know some of you may start to wonder if we're sacrificing growth for profitability. Long term, we believe that the real value of Spotify is in solving problems at the intersection between creators and consumers. With scale, there will be even more opportunities to do so. Therefore, growth is still the most important thing we can deliver. However, equally true
Growth.
is that our hurdle rate for investment has increased. So, what gives? Well, as I've shared before, we have various levers to pull at different times to drive revenue growth. These include growing our users, creating new businesses with new revenue streams, and increasing revenue per user through price increases. In 2023, we leveraged all three throughout the year at various times, but this won't always be the case. You should expect to see us shift back and forth among prioritizing these three key elements based on a variety of considerations. And looking ahead, I believe 2024 is going to be another year of solid progress, led by an acceleration of revenue growth. That said, I think it is important to remind investors that we constantly modulate between what we spend most of our time focusing on. In some years, it's focusing on growing the top of the funnel, and in some years, it's about driving monetization of those users. The last few years has been extraordinary from the top of the funnel perspective. Our aim is to continue this trend, but our focus in 2024 is more on how we monetize that growth. I also wanted to provide a quick update on our audiobooks business, which is performing well, and we are very excited about its potential. It's still early days, but the feedback from listeners and from the industry is extremely encouraging. Data shows that our entry into this market has dramatically accelerated its overall growth. In Q4, we became the number 2 provider of audiobooks behind Audible, which is notable given how entrenched the legacy players are. And this is exactly what we set out to do. Grow the pie for the publishing industry and expand the interest in audiobooks to an entirely new set of listeners. More to come as this takes hold and we roll it out to additional markets. Before I turn it over to Paul to provide more details on the numbers, I also wanted to take this opportunity with all of you on the line to thank him and wish him well. Although Paul is sticking around for a couple more months, this will be his last earnings call. He's been a great partner and helped to solidify the position of the strength that we sit in today. So thank you, Paul, for these years. I also wanted to give you a quick update on our CFO search. We are well underway, and I'm happy with the caliber of the candidates that I'm seeing. As we enter this next phase of focusing on having both a great product and building a great business, I'm confident we will find the right person. Someone who's passionate about driving the levels of efficiency and resourcefulness that are critical to our long-term success. Paul, thanks again, and over to you.
Great. Thanks, Daniel, and thanks everyone for joining us. I'd like to add a bit more color on the quarter and then touch upon the broader performance of the business and our outlook. Q4 is a very strong quarter. MAU grew by 28 million to 602 million, and we added 10 million net subscribers, finishing at 236 million. Both MAU and subscriber growth continued to be above our historical trend and outperformed forecast. Revenue grew 16% year over year to 3.7 billion during the quarter. Excluding the effects of unfavorable currency movements, revenue grew 20% year on year, representing an acceleration of 300 basis points versus the prior quarter's result due to the ongoing effects of the new subscription pricing. Turning to gross margin of 26.7% was above guidance by about 10 basis points, due primarily to favorability in our podcast business. We reported an operating loss of 75 million, which was better than guidance due mainly to lower than expected marketing spend and personnel and related costs. As we previously disclosed, our operating loss was impacted by about 143 million of charges related to the efficiency actions we announced in December. Excluding the one-time charges, we generated 68 million of adjusted operating profit, which is more than double the third quarter as the business continued its early stage of inflection towards sustainable growth and profitability. Finally, free cash flow was positive 396 million in Q4. While some of this strength was timing related, we remain confident that we've entered a new chapter in terms of expanding the business's cash generation potential. Looking ahead to the first quarter guidance, we are forecasting 618 million MAU, an increase of 16 million from Q4, and 230 million subscribers, an increase of 3 million over Q4. We're also forecasting a currency-neutral revenue growth rate of 20% plus year on year, pointing to 3.6 billion in total revenue. We also anticipate a gross margin of 26.4% and an operating profit of 180 million.
Saw that in the deck.
While we no longer give full year guidance, we do expect healthy full year 2024 user growth that should be close to the average of the last few years, and we expect strong
Still
subscriber
growing strongly.
growth as well.
Users.
Gross margin and operating margin are both expected to improve throughout the year to deliver meaningful full year expansion,
good.
with podcasting expected to deliver positive gross profit for the year. We also expect our free cash flow generation to meaningfully exceed what we generated in 2023. And finally, as Brian mentioned, Ben Kung, who has been a trusted
price is
partner of
going
mine in
up as they
finance,
talk.
is also on the call and will be joining us for Q&A. And additionally, I'd like to thank Daniel and all of my colleagues over the past 8 years for making my time at Spotify truly special. And with
Stock price
that,
is
I'll hand
over
things back to Brian
7%
for
now,
Q&A.
up.
All right, thanks, Paul. Again, if you've got any questions, please go to slido.com, hashtag Spotify earnings Q423. We're going to be reading the questions in the order they appear in the queue,
Okay.
with respect to how people vote up their preference for questions. And our first question is going to come today from Doug Anmuth, excuse me, on podcasting. Have podcasts flipped into positive gross profit yet? And how do you think about inflection here through 24 as you're rationalizing content spending?
Yeah, I'll take this one, Doug. Yeah, so I think just to level set with everyone, I think when we had our Investor Day last year, everyone was probably expecting our podcast business to be a net adder to the business and probably thought that the music margins was worse than what they ended up being. And obviously, as we outlined then, podcasting was a drag to the business, but something we were committed to turn around. And I'm pleased to say in Q4, we were very close to break even on that business, which gives me a lot of confidence that as we get into 2024, we will achieve the full year profitability target on podcasting. And so when you think about then what are the drivers for that to happen? Well, it's really two drivers. On the top line side, we're still seeing healthy growth on engagement. That engagement in turns means there'll be more opportunities for us to monetize those engagement hours. And that's the top line. And then on the bottom line, we have doubled down on the deals that worked, and we've got really throughout 2023 gotten out of a lot of the deals that didn't work. And that's the result you're now seeing with the close to break even, and that then will lead to a positive podcasting business in 2024.
Great. Positive. Profitable.
All right, our next question is going to come from Michael
Let's
Morris
see it.
on margins. What are the most impactful steps that will help you progress toward your long-term music gross margin goal of 30 to 35%? And can you share more detail on the gross margin levers in
Market likes it.
2024 and the relative impact you anticipate from each?
Great question, Michael. In terms of the progress on the music margin goals, we see a lot of potential in the growth of our marketplace products as we continue to focus on driving adoption of those and adding value to our label partners, and therefore sort of building upon the progress that we've already made to date in that area. In terms of 2024, I think you've called out some of the key levers with respect to your comment on Q1. Really, the story of 2024, I think, can be broken into sort of these three parts. It's the continuation of the journey on profitability in podcasting. It's the continuation of marketplace growth, as I mentioned, and also just gaining greater efficiency and leverage in our other cost of revenue areas, such as cloud costs and streaming delivery. We think all three of our equal parts importance to the story in 2024, and so we're looking forward to
Google
building
for
on that
cloud.
progress there.
Okay, we've
It
got a question
changed.
now from Rich Greenfield on advertising. With advertising revenues still under 14% of your revenues, I'm surprised to see it's not growing faster than subscription revenue. How do you accelerate advertising growth to reach your goals of it
Good
becoming
question.
20% plus of your overall revenues?
Yeah, I'd say a couple things here. So first, I think we're very pleased with how advertising is growing. Obviously, the market, in a lot of ways continues to be choppy, but our FX neutral high teens growth on the advertising side we think is really strong relative to the industry overall. So we feel good about kind of the advertising growth. That's number one. Number two is we've obviously seen on the subscriber side, faster growth on subscribers in general. Plus, we've had a price increase, and so just the overall growth on the premium side has probably been even faster than maybe we would have thought and others would have thought when you factor in both the outside subscriber growth and the price increase. And the last thing I'd also just remind you of, the advertising business does get impacted more significantly by FX than the premium business. And so when you're thinking about just reported numbers, that also has an impact on sort of the progression. But I think we feel really good about both sides of the businesses right now. So, everything's progressing as planned.
All right, we've got a follow-up from Rich Greenfield on podcasting. How should we think about the revenue opportunity and gross margin impact of shifting from an exclusive podcast like Call Her Daddy or Joe Rogan to non-exclusive?
Yeah.
Yeah, Rich. So I think to kind of up level and talk about it generally and remind people. So when we walked into podcasting, we actually went in with multiple strategies at once. We did exclusives that you're referencing to, but we also did our own and original programming, and we also did licensed non-exclusive deals too. And what we said at the time, I think many people mostly sort of made a reference to thinking that this was an all-out exclusive effort similar to that of Netflix, but we said we take much more of an opportunity approach to the strategy.
Multiple
and we're going
strategies.
to try many different things. And for some shows, exclusives may matter. For some others, it don't. So I think the general story, just to be candid here with all of you on the line, is that what we've seen is that while exclusivities were net positive on the side, it's not driving as much as the opportunity that we see on the ad side. And so by broadening distribution, we think we can accomplish a number of different goals. Most notable among them, we are going to be more aligned with the creator. The creator obviously wants to be on many different platforms and wants to have as big of an audience as possible.
YouTube's big
So
audience.
that's important. And then the second part is when you think about the revenue growth story on advertising, we're very excited with what we've been seeing in early 2023 with these new types of deals that we've been structuring, because we really become aligned with the creator. And long term, that is the reason why I started Spotify. We care equally about consumers and we care equally about creators. So I feel like with this new strategy, we're actually even better aligned with the creator, because we're not asking the creator to trade one for the other. And because advertising is in such a strong growth position for us, I'm really excited about the opportunity we can bring both the creators and to Spotify itself with that strategy.
It's a long answer.
Okay, our next question comes from Zach Morrissey on Marketplace. Can you provide an update on Marketplace and how that performed in 2023, and how should we think about momentum into 24?
Yeah, Marketplace performed really well in 23. Yeah, the growth rate, basically the contribution to gross profit grew at similar rates to 2022. So really strong growth in 23. And then just to reiterate what Ben said prior about overall gross margin, when you think about the improvements in gross margin moving to 2024, Marketplace will be a key contributor, again, along with the podcasting flip and some of the other costs of revenue.
Oh, nearly 8% up.
We've got a follow-up from
Stock
Zach.
price,
You saw strong subscriber
7.77%.
growth and marketing leverage in 2023.
Market likes
How
what
are you
they
thinking
say.
about marketing spend in 2024, and do you see more room for further efficiencies?
Yeah, and just as a reminder to everyone, this is something I talked about, I believe, during the Q1 earnings call in 2023, where I was positively surprised in some of the efficiencies we were seeing and still sort of healthy top-line growth. And that trend has been continuing for much of 2023. And the reality is we don't know how far that will go. I feel good about the efficiencies we're seeing so far. The big concern always when you're making these things is you may see some healthy, positive responses intra-quarter, but then long-term, are you impacting the brand? So we're always going to modulate towards that, but I think what we've been seeing so far has just been pure efficiencies and quite great ones. And I expect there's still some, but the question is still internally, we're still debating how much. The most important thing for us, as I said, is long-term growth still for the company. So that's what we will optimize for. And I think you're going to see us modulate between the quarters. Some quarters we may spend a little bit more on, some less. The most important metric for all of you, though, is to think about the LTV to SAC. We referenced this before. It had been in 2022 and 2023 going down, the efficiency on some of our spend. Now you're going to see a higher hurdle rate, so we're going to be a lot more diligent as we're thinking about these marketing investments overall. But the spending quarter per quarter may be more opportunistic, and you should think about it as such. But if you see a strong LTV to SAC, why wouldn't you? And that's the approach we take.
Okay, our next question is going to come from Eric Sheridan on operating priorities. Following your fourth quarter restructuring, what's your updated view about balancing long-term growth investments, accelerating the pathway to long-term margin targets in the next few years, and or optimizing internal efficiency on an annualized basis?
Yeah, I'll start, and then Paul or Ben, if you want to chime in on that. Yeah, I mean, I really talked about it in my introductory remarks, but it is a new way for us to operate as a company, one where we're consistently thinking about efficiency all the time, top line. We started doing it in early 2023, and I think we're gradually becoming better quarter by quarter, and I think investors should expect the same much for 2024. We are going to continuously look at being more resourceful with the resources we have. That's just the new modus operandi that we have. But that said, that obviously leads to a concern then. Okay, well, are we doing that to sacrifice at the expense of growth? And the answer should be, of course, not. That's not at all what we want to do. We still care about long-term growth because we believe that's where we're going to be able to solve real and meaningful problems for consumers and creators alike with scale. So that's our real focus. But it's a constant balancing act. And I think what you're seeing us, rather than sort of growth at all cost or growth, you're going to see us quarter by quarter optimizing at various parts of that funnel. Sometimes it's top line growth, sometimes it's bottom line. As a general trend, we had healthy top line growth in 2023. 2024 is about monetizing more of that top line growth. That's the general trend, but you'll see in various geographies we may have just MU growth as the goal, and in some others it may be more of a just ARPU approach, as an example.
Yeah, I would just add, I think, to everything Daniel said, if you think about the free cash flow and the acceleration of free cash flow and the better profitability, it just gives the business so much more optionality in terms of what it can do moving forward. And so I think you've seen that sort of inflection on the free cash flow side. You've now seen us on an adjusted basis profitable for 2 quarters in a row, with the forecast again for Q1 of next year. And so all that just puts the business in a much better place for the team to have the optionality to invest in areas that really make sense for the long term.
Okay, our next question is going to come from Rich Greenfield on audiobooks. What surprises you most about the current state of the audiobook market?
Yeah, Rich, I think it's 2 parts of focus. So I think on our side, the intriguing part is we're able to bring a whole new audience to audiobooks. So internally and externally, I think the biggest surprise has been the type of titles that resonate with consumers.
Audiobooks.
These are not the normal titles that traditionally does well, that do well on Spotify, and that's pleasing to see because that means we're bringing a whole new audience to audiobooks, the format, which is great to see. And then I think overall, I'm just happy to see that the partners we have on the publisher side and author sides are just very excited about the innovation we're bringing and very open-minded to trying new things. And this is an industry that's so important, I think, to the world. And, it's great to see that there's a hunger and willingness to innovate among all of our partners there. So that's definitely been a positive surprise. It's amazing to see also how much value audiobooks is adding to our subscriber base.
Yep.
So I feel really good about
for
that.
the same cost. It's good. It makes it so sticky.
Okay. Next question is from Benjamin Black.
15 hours
on
of
margins.
audiobooks as well.
Last quarter you mentioned 2024 gross margins should exceed those of 2023. Is that still the case? And if so, how should we be thinking about the trajectory of gross margins throughout 2024?
Here we go, gross margins.
Thanks, Benjamin. Building on my earlier commentary, we feel very excited about the potential for 2024 gross margins. I mentioned some of the building blocks that we have ahead of us kind of going into this year. And I think you should expect that we're going to continue focusing on what we did in 2023, which is building sequential growth in that gross margin. And it's about executing against those building blocks of opportunity that we have that I mentioned previously.
Okay, our next question is going to come from Jessica Reif Ehrlich on the music business. Universal Music Group just pulled their music from TikTok. What are the implications to Spotify from a competitive standpoint, and how does this impact, if at all, your negotiations with your
I
recorded
haven't
music
said
partners?
much about TikTok. There's a lot of music on there.
Obviously, I'm not going to comment on any sort of competitive dynamic, but what I can say
What
is
he
we
said
feel
last time.
really good about our relationship with our music partners. It's probably at the best it's been. I don't know, whenever it's been better, to be honest. So I feel really good about where we are with our music partners. I feel great about the value we're bringing to the music industry. And I think that's being widely recognized.
Spotify now.
I don't think it has much of an implication, any other competitive dynamic, but we feel good about the partnership. We feel great about opportunities to enhance the partnership to any extent that creates opportunities. So yeah, we're overall very excited.
All right, our next
Audiobooks
question is from Maria
engagement.
Rips on audiobooks.
Yeah.
Could you talk about what type of engagement you've seen with the free 15 hours of audiobooks listening? To what extent do you think the expanded value proposition
It's
is driving
basically one
any
book.
of the subscriber momentum? And are you seeing any uplift to audiobooks purchases in the relevant markets?
Yeah, Maria. So I mentioned that in my prior response, but the engagement has been very strong, very positively surprised about the content mix it's driving as well, what type of titles that our consumers are engaging with. Not very surprising. It is a lot of entertainment. It's a lot about culture. Maybe some of the titles that traditionally doesn't do as well in the book market, but also pleasing is very many younger authors, newer authors as well, given the model where you can take a chance on a totally new book without sort of it eating up the credit, which I think kind of drove you towards more safer bets. So we're seeing a very, very interesting sort of trend around the content consumption, which is really great, and I believe additive to the entire book industry, which is amazing. Now, as it relates to how that translates into our business, I think it's too early to say, but what we've seen generally speaking is the more engagement we have on our platform, the better the value is, of course. And then everyone knows that audiobooks is an expensive proposition where, buying an audiobooks today it costs a lot of money. So it is another reason why we're offering a great value to our consumers. And that, of course, gives us an ability to increase the value that then allows us long term to follow through by reflecting that in the price that we have as well to our consumers.
Okay, next question from Justin Patterson on
Be
revenue
interesting.
potential.
Audiobooks.
Investors now have confidence in your operating margin potential, and the redesigned app is resonating with users. As you look ahead, what should give investors confidence in your revenue growth achieving the 20% targets outlined at your Investor Day?
I'll start with this one, Ben, and then maybe you can chime in. So I think, again, this is very much a continuation of the trend of 2023. And just to level set again, 2023, we walked into the year thinking that we will have healthy top-line growth and focus on the bottom line on efficiencies. And that was pretty much the year, but we exceeded all of our expectations on the MEU side, which then translated into exceeding all of our expectations on the sub side. And then when you topple that with price increases, that leads to a very healthy dynamic. And that top line growth has really been a continuation of that trend in all of 2023. So I've said this before, but I'll say it again. MEU growth sooner or later then translate into conversion to subscriber, that sooner or later then translate into revenue growth, that sooner or later then translates into bottom line. And so, given 2023, I feel really good about our ability to have healthy revenue growth throughout the year. And with this smaller cost structure that we're having because of the focus on efficiency that we had really throughout 2023. We talked about it on the podcasting side, we talked about it on the employee side, but also, as Ben mentioned, with cloud costs, all of the other things that we've been focusing on, that should give you confidence that 2024 will be a great year. I don't know if you have any addition, Ben.
Yeah, no, I think all that commentary is very much sort of the perspective going forward. The funnel kind of our user side and sub side looks very strong, and I think the focus is about sort of monetizing that both from a premium perspective, subscription perspective, as well as focusing on making sure that our ads business continues to grow at a healthy clip going forward. So we feel really strong about
I will summarize.
towards the 20%
Try.
targets.
Okay, our next question is going to come from Kanan Venkateshwar on product. Given that pricing is a bigger part of the growth algorithm, have you considered models beyond the all-you-can-eat framework used today?
In fact, we actually already do have some other pricing mechanics throughout the world. It's easy to think that Spotify is a single proposition for everyone in the world. It's far from today. So, for instance, we have day passes. It's just one product that we're offering in certain markets. Week passes. We even have physical gift cards that people, scratch cards from on a weekly basis in order to top up their Spotify listening. So. We are very much adapting our pricing models in favor of what consumers want. And that's something that you should expect us to continue to do. Now, with that said, to touch a little bit, one of the things, of course, why we are talking about, the Apple case is many things like, for instance, a la carte purchases, things like superfan things like purchasing of audiobooks, top-up things that could be quite meaningful for Spotify's revenues is a significant hindrance today because Apple insists on taking a 30% cut, which in many cases exceeds even our own cut that we're able to take inside of the app. So some of these more innovative things that we would like to do, we're currently restricted in doing on the iOS ecosystem, which limits some of that more innovative things that we would like to do. So all in all, we are already doing it in other territories. We would like to do even more of it, but to do that, certainly in the Western world, which many of these markets being very heavily iOS influenced, we are precluded from doing it at a way which could be profitable and good for consumers and creators because of Apple's stance.
All right, that's a good segue into Michael Morris's question on the Digital Markets Act. You've posted twice about the DMA with the potential positives to your business and then also about your dissatisfaction with Apple's proposed changes. Do you expect the DMA to be implemented in a way that supports your vision? And if so, what do you expect the new functions to be available and how may they impact the company financially?
Yeah, Michael, I think the truth is we don't know yet. We outlined our response to how we would be compliant with the DMA, but obviously that then very much depends on Apple's stance in allowing us to do so. And Apple then obviously subsequently responded with their stance, which is very much incongruent with our stance on the matter, and frankly, I think it's a bit of a farce because it looks on the surface that they're complying with it, but behind the surface, they're doing pretty much everything to make this such an unattractive experience that no sane developer would want to pick any of the new terms. Now, the good news, I guess, from the investor standpoint, and I know that there initially was some questions about whether or not this would be a downside for Spotify. I don't think that's the case. So, we still have the ability to be on the old terms and keep going as we're currently going, but there are future upsides that could be quite significant. We talked a little bit about it with fan clubs, all these other things that we could do for creators that we would probably be barred from doing because it simply would mean that all of Spotify would be unprofitable if we took these new terms. So, no downside, but there would be quite a lot of upside if, in fact, we were going to be able to do what we wanted to do, not just for Spotify, but for creators and consumers alike. And just as a last reminder, this law will come into play in March 7th. So obviously, my hope is still very much that the European Commission will take action and allow this to happen, because it will be far greater for the ecosystem, both for consumers and creators alike.
Okay, our next question comes from Batya Levy on audiobooks. How should we think about the impact of audiobooks consumption cost on margins?
Yeah, thanks, Batya. So as you know, we don't really break out the individual, components like that. What I will say is, while we're investing in audiobooks, we still see a nice improvement in gross margin through 2024, which Ben has talked about, at length already on the call. And so we feel like we have a model for audiobooks and the progression of audiobooks over the next couple of years. It's going to be very additive. We've talked about at the Investor Day where we believe the long-term gross margin of the audiobooks business can get to. And so we're still really encouraged about that. And in general, we're very optimistic that you're going to continue to see, gross margin progression throughout 2024.
Gross margin
Okay,
compression.
we've got another question from Kanan.
Progression, not compression.
This time on the music business. Has growth in international markets helped flip any major ones from fixed minimum payouts to variable payouts? And could we see some impact in 2024?
Great question, Kanan. The short answer to this question is a yes. I would say that it's been a story of steady progress in sort of how we grow the user base and then begin to monetize them in these international markets. And there's really kind of two engines to this. It's about sort of driving subscriber growth and building upon sort of the subscription revenues in these markets, but also making sure that we start to light up the advertising side in these markets as well, both of which basically ultimately help us clear these hurdles in fixed minimum payouts. So I think the story is one of ever constant progress in this department.
Okay, we've got another question from Doug Emmeth on podcasting. With most major podcast content renewals resolved, what are your key priorities for the podcast business in 2024?
Yeah, much more of a continuation of 2023, with the exception, obviously, as you said, we've kind of transitioned the podcasting business from one structure to a different structure throughout 2023. That's mostly done. Now it's back to innovation and growth again. What I'm most excited about is there are lots of things the creators are asking us to do that enables them to easier post content, have more ways of engaging with their audience. You've seen some of this already in 2023. As a reminder, you saw video podcasting growing in a healthy way on the platform. You've seen us add Q&A responses, which is quite phenomenal to see the comments that are showing up on Spotify. Now you've seen much more interactivity, and more creators are starting to use those tools, but that's just the beginning. We have plenty of plans on podcasting, which I think will mean more content on the platform, which I also think means more engagement. So, it's been a profitability story in 2023, and I think that's going to play out. But what we're focused on is really all about now growing podcasting and increasing it. And we think it's a lot larger of a medium than most people really today give it credit for. So that's not what we need to prove, but we're doing so from a profitable standpoint instead of one that's losing a lot of money for us.
Taking a long time though.
Okay, we've got a question from Rich Greenfield on user engagement. Daniel, you've talked about
even earlier
user interest in your Hack Day creation day list, which feels like another AI/ML use case to drive engagement. How is it impacting overall usage and time spent? And by the way, my day list for today is Sad Tailspin Tuesday.
All right. Well, hopefully nothing we're saying on this call today gives you any reason to tailspin on a sad basis. But jokes aside, yeah, I mean, this again is a story of innovation at Spotify. What's so cool is we have these crazy engineers and scientists inside of the company that dreams up these kind of weird and wonderful things, which seems like very narrow use cases, but this is culture. And what they do is they test culture and they bring it out and they personalize culture to people. And it turns out that people are just reacting in this weird and wonderful way, and they want to express their own identity through music, which in itself is not surprising. It's a very core thing for humanity and something that we've been doing. And the team keeps finding weird and wonderful ways for consumers to be able to do that. You know, I think I referenced this, but we saw, you know, searches increased by over 2,000% on their list. So it's a widely sought after feature. People are excited to come into the app every day now to find out whatever Spotify thinks your current mood is of today. And yeah, we keep churning these types of things out. It's kind of our way of creating content. And I'm really proud of the team and the things that they're doing in this department. And it wouldn't surprise me if we see many more innovative things come out of it. Both on, of course, on the music side, but later on also reflecting that on the audiobook side and the podcasting side as well.
Okay, our next question is going to come from Benjamin Black on efficiency. What are some of the key learnings you've seen with the more streamlined cost structure? And as we look ahead, what's your philosophy on headcount growth?
Yeah, I mean, the key things are probably not the surprising things. It's always what happens, right? Initially, when you go through an exercise, everyone kind of says, well, we can't cut this because then all of a sudden everything will stop working. And it turns out that, as is true in so many cases, most things can tend to work anyway, even when you go through that exercise. And it actually, even killing things that sometimes sort of works, is a healthy thing to refocus and re-energize people on the things that really drive lots of value. So those are some of the obvious lessons, which I think you guys have heard plenty of times before on these calls before. I think the more exciting things are the things we're in the midst of learning this as a company. So I by no way and means think we're fully adapted to this new mindset, but I think this is something I wrote in my internal memo that we then publish as well, is this notion of being relentlessly resourceful. For me, that means to think constantly about the resources we're having and not just think about getting more of them, but thinking about how we reallocate constantly everything we're doing to the most and highest impact use case. And there, I don't think we are yet. So I think the good news is that there is still some ways for us to go on it. And I think the way you should think about headcount growth is we're not allergic to it. We're not saying, hey, we can never ever grow anything. We should grow things that obviously are working, but the hurdle rate for any new type of investments will be much higher than what it has been. And more importantly, I think you're going to see us be more diligent in shutting down things that perhaps have sort of worked, but may not work as well going forward into the future. And you're going to see that all across the company in a pretty big way. And I think the biggest takeaway I can give to you, that doesn't mean that the company's in any danger of any kind, because sometimes that get interpreted by media and investors like, oh, if they're no longer showing up in a big way to event X, maybe they're in dire straits and so on. That's not the case. We're just simply thinking about, are there better ways for us to do this? Are there better ways for us to achieve this efficiency? And try to think outside of the box. Maybe it is not to throw the lavish party. Maybe it is to have a virtual party where we could have 10 times the audience come and show up. Maybe it is about partnering with other brands and doing something in conjunction that where 1 + 1 doesn't equal 2 but equals 3 or more. So you're going to see us, I think, still have a lot to learn, but re-question things that in the past have worked, but we need to think about how we do them going forward.
All right, we've got time for a few more questions. Our next one's going to come from Stephen Cahall on margins.
To go.
First quarter is typically the lower margin quarter of the year. Are there any one-time benefits in the strong implied Q1 margin guidance, or can we assume the same seasonality of sequentially improving margins for 2024?
Thanks, Stephen. I think I think you have sort of the right themes in your question there. I think to
They are
reiterate,
improving.
you know, as
They
Daniel
are.
said, in 2023, we had a lot of focus areas between sort of growing our users and subs, driving sort of monetization through price increases and efficiency actions. All of these have sort of taken our core business, I think, to a new stair step. And I think Q1 is sort of where that new core business is shining through. And so I think that implies sort of like a new starting point, I think, for where you can expect the margin to go. And as I said before, our focus is to continue building on that sequentially quarter on quarter into 2024. So we look forward to making progress in that department.
Okay, we've got a question from Richard Kramer on execution. What's the message to the organization about new growth initiatives following your recent headcount reduction? How do you mitigate the execution risk in 2024?
Yeah, I think implied in your question, Richard, is obviously this: how do you do both? How do you, on the one end, save, and how do you tell people that you want to grow? And I think this is why, in my last response, I focus so much about the mindset of being relentlessly resourceful and what it actually means. So I don't think it is either or. I think it's both and. And so I think we need to become more efficient by deprioritizing some of the existing things, but we also need to invest in some of the new. But when we're investing in some of the new, what is the optimal way of doing that? You talk about execution risk. I think it is exactly the right thing and right framing of it. It is about execution. It isn't about strategy. It's about how do we, by constraining the resources we have, how do we think about different ways to executing some of these newer growth initiatives? You know, if the hurdle rate is X, how can we more quickly prove out that something is working? Those are some of the questions that I, Ben, Paul, and the rest of the team is having when we're looking at these types of things and when we're talking to the teams. And I think the good news is that the teams are excited. They're excited to show that there's a different path to do this. They're excited because they also see the momentum in how it currently translates to the business. And that sort of momentum fuels that mindset as well. I think it would have been honestly harder to do so from a backdrop if we had to do some of these discussions, if we had a year and a half of slog of just ever sort of going through this. But we have actually gone through all the hard stuff this past year. And we have plenty of things to learn, of course, but I feel really good about now the optimism that the team has. Never fun to do a riff, of course. And so, you know, we're happy to have this behind us, and we feel obviously a huge sense of gratitude to everyone who's been part of the company and then had to leave. But I know the team is excited about where we are and where we're heading and how it translates into a healthier Spotify.
All right, we're going to take one last question, and we're going to take Maria's question, Maria Rips, on podcasting. Is it reasonable to assume that Spotify is looking to structure most of its podcast deals in a similar fashion to what was reported in the Wall Street Journal regarding Joe Rogan? And how's the company thinking about the trade-off between engagement and advertising revenue or profitability by de-emphasizing exclusivity?
Yeah, I think, Maria, I sort of already mentioned some of these things, but generally speaking, we had multiple strategies in podcasting. It wasn't just all about exclusivities, even if that got most of the sort of press headlines. And what we've been able to see here is, as we've been learning over these past few years, is that while some of these exclusivity deals worked, generally it wasn't aligned with what the creator wanted. The creator wants to have broader audience. And I feel like with these new deals that we've been making for most of 2023, we are in a position where we're actually better aligned with the creator. We can both deliver the growth rate, and we are equally incentivized to drive audience growth and, of course, then also drive revenue growth because we both share in that upside. So I think the team was able to innovate and create a much smarter structure, and that is the path we see going forward on more and more of our deals. I think even on the MU side, it will be on a healthy basis because we're in a very different position than we were just a few years ago in podcasting. Because today Spotify is in many cases the number one podcasting player already. So exclusivity makes sense when you're the smaller player trying to gain scale. When you're the bigger player, the additional value of the exclusivity is far smaller than it is about being aligned. And it feels also that from a values point of view, this is better aligned with who we are at Spotify too.
Great. Thanks, Maria, and thanks everyone for your questions. That's going to conclude our question and answer session today, and I'd like to turn it back over to Daniel for some closing remarks.
Yeah, thanks, Brian. The long-term opportunity for Spotify is strong. Hopefully you heard that now during the call and during the Q&A session. And we will continue to innovate in big and small ways to deliver for our listeners and the artists, creators, and authors on our platform. And make no mistake that we will continue to make bold bets, invest, and seize on the opportunities when they make sense. But hopefully it's clear now with much more disciplined approach going forward. Thanks everyone for joining us today.
Okay, great. And that concludes today's call. A replay will be available on our website and also on the Spotify app under Spotify Earnings Call Replays. Thanks everyone for joining.
Okay, that's it. Interesting. Okay, I will give a bit of a summary. It's pretty late here. It's, as I said, it's 10 to 3 now. So, but I do have thoughts on it. I mean, I don't think I'll make a shorter video on this. There's not a lot of interest in Spotify, especially on YouTube, I don't think. Though I'd like to do more on it. So it's kind of not the audience for it. But so thanks for joining me today, tonight, whenever it is. And I am a Spotify shareholder. I mean, that's probably obvious from what I was saying. Have been for a while. It's been through, if you look at the share price here, the last 5 years, it's been a roller coaster, as many stocks have been in emerging tech. It's funny to say this is emerging tech because it's such a big company now. It's getting big, but the market cap down at the depths was much lower than it is now. As I said, it's gone up 180%. But so it's doing well. And there was nothing in that call that I was really concerned about. Like it was all positive, and the market obviously thinks that way too. It's 8.85%. It's going up after the earnings call. So they had good guidance. The margins are coming up incrementally, slowly, but they are. And Daniel Ek said they would. People didn't really believe him. They've got these different verticals. They've got music. I heard. I think Joseph Carlson was kind of reviewing it, and he was not favorable about it, but he only really mentioned the music, the music licensing, how they're kind of collared by the licensing of the music. But they've got these other bets that they've invested in that are starting to pay off. That for the podcasting and the profitability is starting to come in. They've got audio books, and in their investor day last year they mentioned the other verticals that they haven't talked about yet. So there's plans to grow it. And again, I come to Amazon, how there's lots of different bets. Some might work, some might not. It's just, if they can keep the margins growing, and the user base, over 600 million now, 618 million was it, the monthly active users, pretty incredible. There aren't many platforms in the world with that many users. Google's got multiple billion user platform there. But it's pretty amazing. If they can get to 1 billion people, it's hard to see, even the market cap now with 1 billion users, that it won't in the future go on to do well, I think. I mean, that's just my thesis. I could be wrong. It's not investment advice. But there's nothing in there that concerned me. It's not sort of tanking and going downhill, considering the competitors they've got. They've got Apple, they've got Amazon, they've got Google, these big competitors. And as he was saying, that they are actually the number one podcasting platform, which I think has potential big growth. And advertising, which there were questions there about can you grow revenue in advertising. I can see in the future that it could be really big, but they don't seem to be in that much of a hurry to do that. And they're really focusing on subscribers and growth. but efficiency as well. That's another positive. So it's just one quarter here, but I've been looking at this over time, and it's kind of under the radar. Not many really people talk about it. It's not one of these hugely popular stocks at the moment, like Tesla or Palantir or one of these YouTube stocks that people talk about. It's sort of under the radar, and so but I'm sticking with it, and there's nothing that concerns me there. Quite the opposite. It's positive, and it's been positive last quarter as well. It's sort of doing well, 8.85% the share price. So it'll be interesting to see when the market opens. I'm staying up late, of course. I will stay up till market open, not doing this, but I might as well now. And I do have some buying to do actually, which I'll talk about later. I don't know if I'll do that later on or when the market opens or have a look, but that's another story. Anyway, I think that's a pretty positive call and all, and it was good. It's always good to hear Daniel Ek talk. He's very positive. He's got this long-term plan. It's good to hear that a founder's still there, founder-led again, like Mark Zuckerberg or Elon Musk, but it's a lot more under the radar, but it's not. It's getting to be a big company. And so that's pretty much all I've got to say. It's very late here. That's my summary of it. There's nothing to be concerned about. It's all very positive. I was pretty happy about that. I'll be interested to see what the media headlines are or stories about that. They concentrate on music, but they don't often look in depth. It isn't important as an investor to look at these calls. I think you really do hear. It's good to hear the cadence of their voice if they're optimistic and what they're actually saying, rather than just a press release or even the investor deck. Anyway, that's all for now. Thanks for joining me, those people that have, and to you who are watching this later. I hope you enjoyed this. And as I said, I'm a shareholder, and it's all positive for me in there. I don't see many negatives at all. And great investment that they've been doing over the years is paying off. So thanks everybody. Thanks Pat for your comments there as well. And I will see you in the next one. I might try more of these lives later on as we go on. We'll see how we go. But thanks. See you later. Good night and good morning.